Joining us now is Marta Norton. She is America's Chief Investment Officer at Morningstar Investment Management, and Keith Lerner, Co-Chief Investment Officer at Truist. Good to have you both here. Keith, I wonder if you can get us started with the kind of field position you see that stocks might have right here. S&P 500 closed down 10% from its high. We've been mired in this area for more than a month right now. Corrections are routine, but the circumstances surrounding this one maybe not so routine, given what's going on with some signs of systemic risk and, of course, the geopolitical situation.
Great to be both with you, Mike, and Sarah again. That's right. I mean, as far as the market, we've been in a range about, I think this week, even though the headlines have been very negative, at least domestically, the S&P is only down about 1%. So in some ways, I think that's actually relatively good relative to the headlines. But we see overseas markets down 10%. This really reinforces our longstanding U.S. Equity overweight. And then going to more specifically to your question, Mike, about field position. Listen, I think it's going to be choppy waters here near term. I think the downside, that 4,100 level, that was around an 18 PE for the market, one of the lowest valuations we've seen since the pandemic started. And then on the upside, I think the upside's likely capped around 4,600, and we'll likely continue to have a tug of war near term. As we get later into the second half, as we start to see some of these inflation trends hopefully come down, even though this situation complicates things, I think we'll likely have more of a push to the upside. But again, I think near term is more of choppy waters. Just as a quick follow-up, over the last week on a sector standpoint, to reflect those choppy waters, we've been overweight energy the whole year, but we also upgraded consumer staples, which is still underperforming by about 30% since the pandemic, so have lagged. And we upgraded utilities from underweight just to have a little bit more of a balance from a portfolio structure.
Marta, so many moving parts for an investor right now. If you've got an asset allocation strategy, right? Bonds are down on the year. Yes, they rallied this year. Commodities racing ahead. We do have a lot of these very fast-moving macro factors in a portfolio that maybe has hit more bumps than we got used to in the last year or so. So what do you think are the most relevant decisions that investors should be looking at making right here?
Thanks, Mike. You know, I think one of the top concerns for investors right now is just panic. We have enormous amounts of terrible news, around the world. And we also have concerns around inflation and what rising rates could mean. And this comes on the heels of a really strong market environment that has, something that we've benefited from year over year over year. And so I think the concern is that investors who certainly just aren't as used to any major volatility or negative news could cut and run. And I think that is, one of the worst strategies we could have. Now, whether there are better areas to be in the market than others, I think that's certainly the case. And I think it's especially important that investors consider markets or asset classes that can move out of sync with one another. So though rising rates might be on folks' mind, treasuries still have utility in a portfolio, and they've been showing as much this week. So I think it's important to stay the course, but also to have a very robust portfolio on hand.
Should you boost exposure to commodities, or have we seen the move? And they're still reaching record heights, a lot of these commodities every day.
Absolutely. So from Morningstar Investment Management's standpoint, we've had energy exposure, particularly MLPs, in our portfolio for quite some time. That hurt us in 2020, but certainly in this market correction, it's been a source of ballast for us. Now, we're revisiting the valuations there. It's certainly been a big move. So whether it's as positive going, it's been no valuation is going to be on its side in the same way that it's been. But it's certainly been an area that's more attractive than some of these tech areas that potentially could be more sensitive to rate increases.
Keith, just talking about the large cap growth area, back in, 2020, they had defensive properties, right? FANG was acting like both defensiveness and growth in a portfolio. They've lost that. Obviously, we've had this macro struggle, and they have not really done much of anything except go down, and valuations get compressed. You see that changing? Do you see them coming back into favor for any reason?
Yeah, we still think within tech we have to distinguish kind of what you mentioned more on what parts of tech. I do think the mega cap tech side is still somewhat attractive, given the big balance sheets, giving the cash flow. And if we're going to have somewhat of a slower global economy and a somewhat slower U.S. economy relative to what it looked like before this, then I think on the margin that becomes a bit more attractive. But again, I think that's having some ballast. We also have an overweight towards real estate. If you look at the REIT index as an example, that also has a tech component to it. That's held up really well, has a nice dividend. And we're also overweight energy. We've been overweight the energy sector for some time. It's been a great outperformer. I suspect that is more likely to pause after this big run. But like I said, I think it's a point in the cycle where we've been very bullish the last 2 years. We bring that in a little bit, and even your sector exposure should be more balanced relative to where we were early in the cycle, where the risk reward was much more one-sided.
Yeah, obviously it's kind of the mid-cycle, maybe late cycle playbook. Keith, Marta, thank you very much. Appreciate it.